Okay, welcome everybody to today's Worth and Wealth seminars. Today's seminar is going to be on managing debt. I'm Carrie Palazzo. I work with the State Treasurer's Office of Economic Empowerment. I'm joined by my colleague, Jennifer Duran. As I shared, today's presentation is on managing debt. Okay, it is my pleasure to introduce Erin Smithers to you all today. Erin is a senior risk manager in consumer fair lending compliance at Citizens. With over 20 years of experience and roles across consumer credit risk, business banking, and quality assurance. She also manages the Prepare RI internship at Citizens and leads the Elevate Community Pillar, focusing on workforce development, financial empowerment, and community engagement. Erin holds a BA in Business Administration and Enterprise Risk Management and an MBA. Excuse me, a BA in Business Administration. Sorry, Erin. Erin, thank you for joining us today. We're really looking forward to this presentation.
Thank you so much for that introduction. Good morning, everyone. It's a pleasure to meeting all of you. And today this is a very big class for this particular session. We'll try to make it very interactive. So let's get this started. So it's really about managing debt. So let's get this started. So what is exactly debt, right? To understand debt, we accumulating debt from many different ways, and sometimes due to life hardship, sometimes it's just matter of fact that if you are going through, let's say, student lending, maybe you have to co-sign something for your children and all of that. So your debt is really something that you owe, right? And so you should understand that who do you owe that debt to, what financial institution that is, and how much are the monthly payment. Generally, they are. And also, I would say that, what's the interest rate? What date are they generally due? Can you stack certain payments? And also the other important fact about the debt is that an installment loan? Is that a revolving credit, right? Is that a private debt? Is that something that you could actually consolidate? So all of that, the more information that you know about what you owe, what exactly is the back end information, and it would help you to managing them. So I know that we quickly talked about that sometimes to accruing debt, you could basically, I know that there are people that lost their jobs and they had to use their credit card for a certain period of time. I had to do that I was a single mom for many years. And I know that at certain period when I didn't have any child support, I had to use a credit card to pay for the groceries. And that was something actually paying for the need of both my children and I to survive. So that was really something for the need, right? And there's also here that I mentioned about purchasing asset. So for example, that we may all have, some of us have cars, and not all of us is going to pay for a car outright this cash. So we would have a car loan, and those would be considered as asset. Right. And asset also could be that in the way of pursuing education. So that's also a type of asset that you would be gaining that's building your financial future. And sometimes that we might use these to pay for bills, right? Electricity, or, I actually set up my electric payments and a lot of different bill payments actually on the credit card, because I pay them right off every month. Both my children I have two children, they're both in West Coast. So in this case, for me, although it appears I'm paying something that, this credit card, but I'm actually not incurring that. It's continue to, if I pay them off the next month, in some ways, it's actually gaining the points while I still to pay them off, right? And then also cover sometimes unexpected expenses, and not, right now with the cost of living is so high, it's really, really hard for a lot of people to have emergency savings, and to have, all of us supposed to have at least up to 6 months of our monthly income saved for emergency. And not all of us can have that. So I think, if there's emergency usage, for example, that, winter's coming, I cannot tell you that how many winters that I actually accrue. I had to use my credit card for replacing tires. So since then, I actually did start an emergency saving for these, unplanned expenses. But that's something that, if you don't have it, and obviously we do have to pay for these. And I know that there's one time, one of my rescue dogs actually broke his leg, and I had to put the entire emergency expenses on the credit card, and it was $3,600. Of course, since then, I start to get a pet insurance at work. And then also sometimes that you may want to buy things that either it's what you want or what you need, right? So all of this, that if you're looking at it, there's many different ways that we might be recurring debt because of that. And how does that actually would affect your financial situation, right? If we're looking at, before we actually go to the next slide, sorry. So I know that there is a podcast, actually, I don't know if it's still on, actually, it's on National Public Radio. It actually talked about student loan debt. There are a lot of people talked about that because of the debt that they carry, it affects how they even want to get into relationship. Think about that. You thought that you're building a future, and then you have, hundreds and thousands of in student debt. This for you, that for certain jobs that you are applying, this probably would prevent you even to buying a house. And there are certain people shared about that. And it also affects you to getting other, to get other asset that you may want to have as well. So let's take a look at this scenario. So this particular one, that it's really about, if you want to understand your debt, you really need to understand that exactly some of the things we talked about. What are the monthly billing and also the statement that you would get, right? And I generally put a Excel sheet, even though I track my expenses on the app, but I still use an Excel sheet. So in this case, I know exactly how much that for each monthly payment that I need to pay on what date, what's the APR for each of the payment, for each of the debt that, let's see if it's a credit card, car loan, I have a little bit of student loan, and I have a personal loan, and all of this, you could list them out and to see that how are you going to be managing those, and who do you owe that to, right? Is that the Synchrony credit card? Is that American Express credit card? And also, if that's a loan payment, who do you owe that to, right? And also sometimes I actually put, besides the due date, I mentioned about the interest rate. I also actually put down that extra column that I added in there to add in how many extra payments I could put in, and on the monthly basis at how much that's accumulating, right? So, and then also the other things that you can also find out all of this information is actually by pulling your annual credit report. That's annualcreditreport.com. So how does actually that works, right? So if you're looking at this little picture from actually FDIC Money Smart, there are many different things that it could actually affecting how you're managing the debt, and also in some ways that how you can repaying them back. So here that some of them talked about that there could be the way that you set it up. Do you actually managing your debt in some ways? For example, that I have automatic payment, right? I have certain emergency funds that linking to certain how I manage my income and manage the savings. And then in the interim, I'm constantly monitoring my debt. And so right here, that let's take a look of generally for something that you owe, if it's either it's an installment loan or a credit card, and the loan payment generally it's listed on your loan agreement. I don't know about you but I read all the loan agreement very carefully. I think it's maybe nature of my job that, working as a senior risk manager, I've read many, many different agreements. And also under fair lending, that as consumers, most of the creditors, even including in their marketing materials, they have to list out, like choosing lending, right? They have to list out the principal payment, if it's a secured loan, that, what exactly is the annual percentage rate, which is short for APR. And then it also needs to list out all the hidden fees. So for example, that if you have a late fees, if you have other penalty fees and all of that, it's all has to be listed clearly and in really plain language. So, and then how much money that do you actually borrow, right? So this includes, for example, that I have a car loan. Last year I had to buy a new car. And so for my monthly payment, there's the principal payment, there's the interest payment, and there's maybe additional fees if I was late, for example. So you need to understand that exactly what made up to your monthly payment. And for me, if my car payment, let's just say that it's $400 a month, I generally try to pay at least $100 a month extra, so that I put a note in there that to say that it's the extra payment will go towards principal payment. Because think about that, principal payment is how much you owe, all of that, right? Interest is tagged along as basically the interest charges based on what you owe, which is the principal payment. So the more that if you can pay down your principal payment, imagine the interest, actually you would have a less interest that you need to pay. And obviously you want to try to avoid fees as much as you can, because some of the fees could charge up to $39 for late fees. And then not to mention that if you're using a check, that you have non-sufficient funds, and you also get additional charges from your bank as well. And the main cost for borrowing money. So I'm actually going to now opening up to see that, asking some of you to see that what exactly this main cost that for from borrowing money. Is that current balance? Is that interest, or is that credit? And feel free to put it in the either put it in the chat, or you can blurt it out. All right,
Okay,
Jen,
Erin, yes, so we have interest here as one of them.
yeah, that is the interest,
More
exactly.
interest, sounds like that may be a big one.
Yeah, that's correct answer, exactly. So, and then now the credit agreement, it says that how the money is, give me 1 second, I'm actually gonna stop sharing and then come back because my cursor is not working. If I actually can go there, because there's a one thing that is blocking me to see. Yeah. All right, let's actually get going. Okay, your credit agreement shows that how much money you borrowed from time to time to a pre-approved maximum of credit line. So what is that? Is that an installment loan? Is that a revolving credit? Or is that a lease agreement? So what exactly is that? And I'm paying attention to you. I just need to open up my laptop so I can actually see the slides as well, because I can't actually go there.
So we have revolving credit.
All right.
And
Anything
revolving-
else?
Yes, we have 2, 3, 4 revolving credit.
All right. Can somebody actually unmute yourself and tell me that how do you justify it's a revolving credit?
I am not sure if the participants can unmute
Okay, but
at
put
the
in the
moment.
chat if they want to.
What was the question?
So why is the answer as a revolving credit? What would be the difference actually between a revolving credit and an installment loan?
So for the participants, if you guys raise your hand, I can unmute you.
We're not having a quiz, so it's no answer is bad answer. So the other thing I would say that when we see revolving credit, generally it's basically like this question is it's actually listing, right? So it's pre-approved for a certain amount of money. So when you say revolving, it's think about a revolving door, right? So it's really credit cards. So something in that type of product. Installment loan, it's generally a set amount that you borrow that and you probably have a monthly payment. I mentioned about the car loan that I have, right? So revolving credit, generally depending on what your credit report showing your credit score is, and then you may be pre-approved. Let's just say that for my American Express, I actually have, I think, $20,000 for the American Express credit card. Of course, I've never used that much, but I try to not to use for all the revolving credits. One of the trick is not to use more than 30% of what you were given, the maximum of credit limit, right? So, and what is actually revolving is, so let's just pretend that the $20,000 American Express card I have, right? I can basically, I'm allowed to borrow up against $20,000. But is my monthly payment going to be the same? No, because it depends on how much I actually use it. I mentioned that both my children are in West Coast. So now I'm actually intentionally using my American Express more. So I paid off every month, but at the meantime that I can use it, so it gives me, it has a Delta airline miles, right? So depending on every month how much I'm using it, and the revolving credit, it shows that my monthly payment is tied into how much I'm using it. All right.
We
So
got a good definition in here. Someone said ongoing varying amounts, borrowed versus fixed amounts upfront, which I think summarizes nicely the
that's
explanation.
exactly. Yeah. So although it's a fixed as the limit that you have, right? But in general, it's actually, even with credit card, sometimes you may, for example, that if I decide that I'm just not going to pay my bills on time, well, guess what? They may actually give you less credit because sometimes they do see that, right? And you know how in most of credit card company, they actually ask you, oh, can you update your income? If they see that you have an income decrease, they may actually give you less credit limit as well. So now what is the total cost of a credit? Hold on, I can't see the next one. What is the total cost of credit on the yearly basis? And this is something that I want you to think about, that I think the question in general, it's a little bit vague, but let's hear the answers first.
Someone mentioned APR.
Yep.
We have a few of those.
Okay.
So far, we just have and annual fees as well. Someone said annual fees. Someone said all of the above, all three.
Yeah, so I think this particular one is actually annual fees, because annual percentage rate is actually about interest. So there are not all revolving credits that actually have annual fees. I mentioned about American Express card. I used to have they give me a gold card, and then 2 months down the road, I received this bill. The gold card actually costs $100 a year, right, to have that gold card. But it's the same benefit that compared to, let's say, a Delta Blue card. So I basically opt out not to have the gold card, because unless they can waive the fee, I wasn't going to just, what's the point of having a gold card and without extra benefit, but then I have to pay extra fee for it. So I would say this is actually the annual fee that sometimes you get charged to have what you have. All right, so the next one is actually when you borrow specific amount of money and repay it over a period of time. So you borrow specific amount of money and you pay it in a certain period of time. So I want you to think that this is the type of loan product or lending product that let's just say that you borrow it in the set amount of money. Then it comes from certain terms. So the terms generally it's divided by 12, right? So it could be that, 3-year term, 5-year term, 7-year term, something like that. So what do you think the answer for this one?
We have 4 or 5 answers for installment loan.
That's actually the correct answer. It's the installment.
Yes,
So I
nice job.
mentioned about my car loan. You were speaking, Jen, sorry.
No, you're good. I said nice job, everybody.
Yeah, exactly. Good job. So installment loan, it's exactly like this, that you borrow a specific amount of money. Let's just say that if my car loan, I think was $26,000, something like that, then obviously I put down a big down payment, right? So that's the way that to lower the principal payment, because that's in general what you have to pay over the term. So I actually had a choice to either choose a 3-year, a 5-year, or 6-year, something like that. I think there's also an option to 7 years. I actually chose 5 years. I know that in between 3 years to 5 years, my justification was that compare my car loan to if, let's say, I have a credit card payment or, less in case to say that if I have a credit card payment, that it's actually accumulated debt that it needs to pay off. And let's just pretend that the interest could be, I think they charge up to 34%, right? Compared to my loan payment for my car, it's a 6.5 or something in that range because I have a really good credit scores. So why would I want to rush to pay off the car loan? There's a bigger monthly payment. Well, if I have other debt, right? So I think this is the way that you want to think about it. But installment loan is exactly what it is. It's basically you borrow a set amount of money and then you have a certain terms that you have to pay it off. And that certain time, the period of that time, that's basically your term that you can choose. All right, so the next one is actually a loan without a collateral. So what exactly is a loan without any collateral?
We have a lot of answers for unsecured. B.
That's it. Oh, my cursor just started working. All right, so unsecured exactly is the correct answer. Because a loan with collateral, I mentioned about my car loan. My car loan, it's basically a secured installment loan. So that's what you can think that, right? And I no longer own a house, but prior to, I'm located in Providence, Rhode Island. So when my children were home, I had a 3-bedroom house, 2-car garage, a big yard, and the whole finished this basement and all of that. I had a mortgage. It was a 30-year mortgage. So the mortgage itself is also a secured loan, right? It's an installment loan. So now that when I moved to Providence, I no longer have that. So now I just have a secured loan for my car, right? So I wonder if any of you have either mortgage or have, for example, that, have car loans or all of that. Any of you have secured loans? Personal loans? Yeah, exactly. All right, that was unsecured. Car loan. Thank you, Suzanne. And what is the term on your car? How many years do you have to pay that off? Car loan and mortgage. Thank you, Tessa. Yeah, so a lot of us have, my son used to joke about that. It's hard to be a grown-up because all you do is making money and then have all the bills to pay, right? So now that let's take a look of the comparison of what exactly is installment loans and what is revolving credit. I think some of them we already talked about it through some of this little cute pop quiz, right? So you installment loans compared to revolving credit, you will have the amount that you totally owe, right? Let's say you have a car loan that you bought the car for $20,000. That's the principal payment. But if you put down a down payment of, let's say, $8,000, then at that point, your principal actually become 12,000, right? So that's how you calculating that. And then the term is how long do you have? How many years does it take for you to repay that back for what you owed, right? And then generally, the more that if you pay the amount of every month that you pay certain amount of certain payment amount, unless if you have a certain adjustable or variable rate. And most of the installment loans, especially on the secured ones, it's actually fixed rate. So, and then compared to the revolving credit, it's really the most you could borrow, depending on your credit score, or, depending on how much you actually want to borrow. Because I know that if you hold credit cards, sometimes you can actually ask them to increase it. If you have a good credit history, you actually not utilizing it more than 30%, they probably more than happy to increase that, right? And then it based on the credit that you used, right? So we talked about that utilization. So it's really, let's just say that I have that $20,000 American Express. Let's say that this particular month that I decide to, buy something for my son that who's trying to fix his house. And if I spend $2,000 on there, for this month without paying it off, then the next month's payment would be based on the amount that I spent and if I had previous balances. So that's basically that was. Wow, Suzanne, I just looked at it. You said 7 years at 2.1%. That's amazing. All right. So minimum payment, that it's basically based on the percentage that you borrowed. So the percentage you borrowed, it's from 1 to 5%. So if you use less, obviously your monthly payment is going to be less on the revolving credit, right? And then also you can basically with both that I would say on the revolving credit side that try not to just make the minimum payment because it's going to take you a long time to pay it off since the interest is a lot higher compared to most of the installment loans. And let's see, and generally depending on both loans that they probably would depending on your credit scores that, and also your income to be able to pay that back. I know a lot of the secured loans were installment loans that they actually looking at your debt to income ratio. They look at many different things to determine the risk score that you have as a consumer. All right, so let's take a look of this scenario. So this particular scenario actually says that, expand my screen. All right. So it says that Zoe wants to learn more about student installment loans, right? So Zoe knows her credit needs some work. She learned her financial institution offered something called credit building loan. And the credit building loan would allow her to borrow $1,000 and repay it over 12 months at 12% annual percentage rate, which is APR for short. Her payment would be reported to one of the 3 national credit reporting agencies. And as long as if she's making her payment on time as agreed, this would help her to increase her, her credit score. And she thought this is a good deal. So let me ask all of you, have you actually had something like this type of secured installment loans like this? This is more of a credit building loans. This is also very good for somebody that if they're trying to rebuild their credit. So this is basically you you're borrowing against what you actually put it in. So in general, it's a good option that when you try to reboost your credit score and try to build your credit history as well. So this is, let's take a look actually, if this is the case, right? So let me ask all of you, you can put it in chat. If you're looking at this chart right now, so this $1,000 is the beginning balance, right? So what exactly is the scheduled monthly payment? So how much does Zoe has to make on the monthly basis? 88.85, correct. Thank you, Tessa. And also Curtis, thank you. Yeah, so scheduled payment in that column, that's basically showing you what exactly is her monthly payment, right? And also how much it goes towards interest from the first payment. Yep, thank you, Tessa. That's it. So it's the next column, it shows interest, right? And then, and then what about that? How much it goes, so what does the amount interest in each payment decrease? Oh, why does that decrease? What do you know why it decreases? Exactly. I would say the principal payment increases. It decreases, right? Because if you think about that, if you owe $1,000 to start, so your interest charges is actually based on $1,000. But if you actually decrease that principal, remember when I mentioned that if you have a car loan, if you have a less principal on your car loan, you actually would pay less interest, right? Because that's all based on your interest, based on the principal payment. So why does the amount principal in each payment increases? So why does why is that amount increases? So the more that you're paying down your principal payment, in the long run, the ending payment, as you can see that for the balance, you're basically, exactly. So you're paying, when you're just starting a loan, you're paying a lot on interest, right? But towards the end, you're paying a lot less on interest because the principal payment is a lot less. So thank you, good job. That's exactly what it is. So now let's take a look of this, so let's take a look of revolving credit, right? So compared to the $1,000 as a secure loan, it seems like a pretty decent option, right? And not to mention that it definitely helps her to rebuild her credit. So for this particular one, so Zoe decided to use her credit card to buy something that also costs $1,000. And her credit card has a 12% annual percentage rate. And this slide is it's fairly old. Nowadays, I think it's really hard to get actually an APR on the credit card for 12%. So she doesn't use her credit card for other purchases. Each month, she only pays the minimum amount, which is 5% of the balance. So let's take a look, the comparison, right? So, all right, so starting from here, and also let's refresh, taking a look of this. I want you to take a quick snapshot of how this been paid down and compared to a revolving credit. So before that was installment loan, right? Now it's actually revolving credit, and she is only paying the minimum payment. So first I want to see that why does the amount change every month? Curtis, I absolutely agree with you. That's why it's always good to ask if there is a prepayment, repayment penalties. Absolutely. That's all in the loan agreement, because it's always good to read everything, especially in fine prints. Absolutely agree. All right. So why does the amount changes? I think we talked about this. It's really for revolving credit. It based on the payment changes it's due to how much you're actually how much you're using it. If you're using more, obviously from 1% to 5% would be your monthly payment, and that would also increase depending on how much you borrow, right? And after 12 months of making minimum payment, how much does Zoe still owe? Because she's only making the minimum payment, so it doesn't look like she's chipping down her payment or principal payment that what she owes, like the installment, right? So at the end of this, looks like she still owes $612.71. All right, and also, how much interest has Zoe paid? That's right, $96. And let's take a look at this. Right, so you can compare from the both scenarios that one at 12 months, it's actually paid off. But on the flip side, if it's a revolving credit and you continue to use the credit card and you only paying the minimum payment, it's not paid off, right? So in some ways that you actually really have to pay more than that. And I generally think that if you credit card, it's good to have, it's convenient, right? At this point, a lot of my the miles that covers when I have to travel to go see my children, for example, that next week I would be traveling to Washington State and all the miles are covered, right? Even sometimes like including the extra perks that the hotels are covered as well. However, it's because I can actually pay them off. But if you can't pay that off, you carry a balance. And this scenario, it would show that if you can only making the monthly payment as a minimum payment, then every month it recruits more. There's more interest. And not to mention that if you actually have penalty on late fees and something else, right, it all gets piled as part of that. So the fees, we talked about that there are additional charges. They're not interest, right? So they could be late fees, it could be annual fees. So make sure that you really understand, for example, that I thought that it would be fun to have a gold card, but if it's going to cost extra money, I really don't need that. And also, I don't know if you pay attention to your monthly statement for your credit card. By law, by regulations, banking regulations, they have to list how much you actually are paying. If you're only making the minimum payment, how many years more it's going to take you to pay that off. And also, if you're paying a little bit more than the extra payment, how much less it's going to take you. So pay attention to the hidden fees, right? And they, most of the loan and credit card companies, they all have fees. And they're not interest, right? So they charge you annual fee. I mentioned about late payment, and sometimes they also charge you over limit fees. And car loans that they sometimes charge you documentation fees, closing fees, and also your mortgage, there's also other fees as well. So, all right. And I think that was, let's see, I think that was Curtis who said if there is a prepayment penalties, right? If you actually prepay that early and paying it off, is there a penalty fees in there, right? So it's always good to ask those. So early payment of the loan, that if you repay, you pay the lender, sometimes that's basically, for example, that if you have certain terms and they tell you that, spell it out, that you can't pay that off early. Let's say you have a personal loan that is scheduled for 5 years, and even though if you could, they would tell you that you can pay it off, but there would be a penalty. So that, some of those, right, it could also be that there's additional fees to that. So always ask if there are any fees that is charged if you're going to prepay that. Okay, so also another thing that to pay attention to is, when you think about that, if you have debt And which one are you supposed to be paying that off? So consider that if you have a different debt, you have a different credit card, if you have different installment loans, which one do you want to pay that off first, right? Do you pay off the ones that is the highest cost, or do you pay it off with the lowest balance? Because it depends. So for example, once I finished my MBA, that I looked at my student loans. Citizens has reimbursement, so I was left with a small amount of student loans. And so when I looked at it, there's a couple of loans that were only very small amount of balance. So I paid those off first because it takes me, let's say, 1 month extra to pay them off. So I actually took them off of the equation, right? But credit card as well. So for example, that if you have something that is the highest interest, and you may want to pay those off earlier because they will accumulate more, for the monthly payment, for example, right? And they also depend on your ability as well. So you want to take all of that into consideration. With high cost debt, right? When you pay off the debt that is the highest cost to you, this is generally this highest interest. And the snowball method, and sometimes it's also considered that if you pay off the debt with the lowest balance first, right, which is what I mentioned that I did with a couple of my smaller student loans. All right, so let's take a look at this scenario for next slide. So this one, it actually says Brian planned to reduce his debt. It took Brian some time to find a new job after the hospital where he worked closed, but his new job at the medical supply warehouse makes a great use of his skills. He likes the people he works with. Now that he has a steady paycheck, he has some money saved for emergency, and he can start to reduce his debt. And those debt include credit card debt that accumulated during his period of unemployment when he was not working. His car loan, his medical debt from when he was in the hospital a few years back when he was sick. So Brian's sister went through a similar financial situation. She told Brian about the high cost debt first method and snowball method to reducing his debt. So Brian wanted to really investigate to complete worksheet to get a better sense of how each method works. So his sister actually used the snowball method. So Brian wanted to see which method would actually help him. So let's take a look. All right. So this, let me switch. Okay. So if Brian is utilizing the high cost debt first method and look at how he's listing his payments, right? So his principal balance, actually, how much he owes as debt. So from here, it would list the highest interest first. The highest interest, obviously, it's the credit card, then it's the medical debt, then also it's car loan. But if it's a snowball method, it's actually would list the smallest amount that he owes to the biggest amount that he owes as debt, right? So, so which method that do you think? Let me ask all of you that which method should he actually use? I know that his sister actually used the snowball method. And what do you think would be a good idea for Brian? And what method should he be using? All right, Suzanne said high cost. Okay. Anybody else? And Tessa said high cost. Yeah. And why? The interest charged, exactly. I agree. Because it matches, he's also, from the previous slide, all right, Tessa said the percentage rate, 14%, very high compared to 6%. Exactly, absolutely agree. For example, that I think one time I actually as I was doing the snowball method with my student loan payment, I was talking to my daughter who also have some student debt, right? She went through master's for social work. So when I talked to my daughter, I said, oh, I'm trying to pay off some of those student loan debt. And I said, I'm trying to pay off the lower balance first because just to knock them out. She says, why, mom? Those are government loans and they are fixed. And maybe you should actually pay off one of the credit card payment that you're still trying to pay it off. So I think that was such a good justification, right? Because exactly like Tessa has wrote in here, that the interest, when you think about that, 14% compared to 6%, clearly, right? So because if he's using the snowball method, it's actually in some ways that he might accumulating more in payment. So good job. Thank you for that. All right. So this particular slide is basically talking about that. How can you getting help if you actually need to either reconsolidate your loans or maybe having loan settlement companies, right? So here that we have loan settlement companies that they may make deals with your credit card, with your creditors. Sometimes it depends on, what kind of debt you have. Even this, if you have medical debt, generally don't go on to the credit report unless if you're past due sometimes more than 180 days. And most of the companies that they would actually source those to third-party collections, sometimes lawyers' offices, and you would get phone calls from those collection agencies, right? A lot of the collection agencies would offer you a settlement or payment plan sometimes. So you can actually talk to them about what actually works for you. So in that case, you could maybe settle for less amount. And same thing for charged off account, right? So for example, that if you have a car loan that you didn't pay for many months that get charged off, it's really bad for you for your credit card, for your credit score. But at the meantime, while you're trying to repair that, you may have a balance that was charged off. You can certainly work with your financial institution or the creditor. And if they are trying to collect on that balance, you can see that if you could settle. The only thing with that is that if you settle on the settled amount, not the entire balance that you owe, it also will show up on your credit report to say that you settled in full rather than paid in full. So pay attention to that. And also there probably also have fees and process that involve to that as well, right? Consolidation. I know that sometimes people refinance their loans, they have a mortgage, they have, home equity. I did that when I actually had to fix the roof and putting in a new kitchen and all of that, right? So, but sometimes you can reconsolidate some of your payments. You can refinance your mortgage. You could actually refinance your student loan. If there is different creditors, different lenders, you can actually go through them this one. But all of those, you want to shop around and you want to make sure that you learn about the interest, the rate, and all other costs, right? So you really want to consider that, to maybe looking into also a nonprofit credit counseling organization as well. The only thing I want to warn is that nowadays with Gen AI, there's a lot of fraud out there. So unless if you know exactly if that's indeed a nonprofit credit counseling company, you don't want to sign up for something that you may think that they're trying to help you to settle debt or reconsolidate your loans and to build you credit scores for all of that, and they may be fraud. So just be very, very careful with that. And you also want to, let's see, you also want to compare to see that what exactly is you currently what you owe, what's the interest, what's the monthly payment, and the term, and all of that to see that if it's actually even worthwhile. So sometimes that, when you reconsolidate, your loans, it's basically could be that you may have a smaller loans in smaller payment, but they're all scattered in different places. But when you actually consolidate them, maybe you're saving in the long run, but at the meantime that your monthly payment may be lump sum to one. So lot to think about. And let's see. All right, so let's move on to the next one. So the key takeaway, obviously, it's really don't ignore, if you're getting a phone call from a debt collector, don't ignore it, right? Make sure that you ask questions. And I actually started in the phone bank, not phone bank, but in customer service in collections. So I actually was one of the ones that you would talk to, this was long ago, and collected on either student, car loan, home equity, depending on what the job load was. And for me, that one of the ways that I always realized what made me one of the best collectors on the job was that I've always focused on what the customer need was. So when you're getting a call from a collector, make sure you talk to them, right? Make sure you figure out that if there's any options that they could offer. If you're in the bind, do they offer any deferment? Do they offer, if it's a car loan, is there an extension? Can you get that extension with, prepaid interest so that you're not getting a balloon payment? Look into your options and really kind of weighing over to see that how can you pay those, right? How can you pay those off? How can you actually utilizing all the strategies that you have to help you in that regard? And also, I think sometimes that you don't know if there are options out there. I know for citizens, this was 20 years ago when I started in there. And I think soon after that, I actually went to work in quality control and to train people how to really behave on the phone, to focus on the conversation, to really talk to our customers, to finding the root cause and offer the options, not to be a quick fix, but to really looking at their bigger financial picture to help them getting out of there. All right. So let's take a look at this slide. So this is basically, it's something that I think we already touched upon, right? So the cycle of a debt, right? It really is about you taking out a loan, you taking out the debt, and you paying on time as you agreed. That would be considered as current. And if you're not paying it on time, we call that delinquent, right? And always thinking about that for your credit report, 30% of the credit scores is actually based on if you're making on-time payment, because every 30 days gets reported to the credit bureau. So when you're delinquent, it could be 30 days past due, 60 days, 90 days, it accumulates. The more days you pass due, and it's harder for you to repair that, right? And then gradually, if you're paying that as a grade, and then within certain terms that you'll be able to pay that off. So I'm going to stop for a little bit because I know that was a lot. I want to know that if you all have any questions. All right, so let's move on. So once again, elaborate a little bit more, is that you take on the debt, in this time, right, you probably having a hard time, right? For example, one of the scenarios we looked at, Brian lost his job, that there's no financial empowerment when you don't have a source of income. So I think in some ways that, due to circumstances, right, we all have certain hardships that upon us. And so, for example, for this one, that if you have missed payments, and this would make you, rather than being current on your loan, you're actually delinquent, right? And then it means that the status of your loan is actually in default, you're delinquent. And we also mentioned something that your loan could be really in jeopardy, and maybe it's more than 180 days past due, let's say, for let's say your home equity loan, that could be potentially charged off and written off as a bad debt. That's basically what charge off means. And for example, that if you have a car loan and more than 90 days or 120 days past due, maybe it gets repossessed. And when you get your car repossessed, and there's the repossession fees, there's many other fees that sometimes involved in there, right? And not to mention the credit report that affects you in the long run. So all of those either, and or if you have to, foreclose on your house, all of those, it takes 7 to 10 years to actually repair. So think about you missing payment or having your loan to be in the default state and all of this. This is all going to be affecting you in the long run, and it takes a while to repair that. So there's also going to be collection calls, right? And you may be getting calls from different collection agencies. I would say that, really answer the call sometimes, because I know it's dreadful. I was a single mom for many years, and I know that, when you're weighing off which one to pay and while you have to support your family, it's not easy. So make sure that, I know that one of the slides that we talked about, that answer the call, looking at the billing statement that they send you to see that if you're able to set up either monthly payment to repay that, or is there a way to actually settle, right? Or maybe somehow that you could actually talk to a credit counseling agency, that nonprofit that could help you actually to really looking at something that in the long run. All right, so this particular one is really kind of a continuation of, let's see. Dana says, okay, makes sense to borrow from 401k. That actually, I would not recommend that, Dana, is only because there is penalty on 401k. Not only that, you actually get penalty, not just withdrawal money from there, and also you have to pay tax back as well. So that would not be a good option to take out from 401k. Yeah, especially if you're not at the retirement age. So there's definitely penalty in there. I can actually send, I'll make sure I write myself a note to actually send you the Social Security site that from the government. There is a site that it give you the calculation. So from there, it's actually going to also show that if there's pre-penalties from if you're taking out Social Security early. But from there, that would be a good source of information, but definitely not a good idea to actually borrow against your 401k to pay down debt. No. Another thing that I would say is, I don't know all of you have, I actually have a HSA savings account. So that's also a savings that I don't take out. I just keep on putting that in there. Whatever that I don't, so it's a healthcare savings account that it's linked to my Cigna healthcare from Citizens. So, but when you reach 65, you can actually use that without actually penalty. So, but 401k, I would say that it's not a good idea at all. I would say that look into other options rather than actually withdraw from your 401k, right? So also you could definitely looking into your credit report, because in your credit report your annual credit report that it shows you what we call trade history. So it's basically how many outstanding debt that you have out there, how long is the history, and also what exactly how many times that you were past due. And from there, you can actually taking a look, right, from listing those, like what Brian did, maybe listing them to see that what's the highest interest that for among the debt that you have, different different creditors that you borrowed money from, and to list that either it's a snowball method or it's a high cost. So in that case, you can compare the interest, then looking into either reconsolidation or maybe try to pay them off, especially the higher interest, right? So we did mention that, if you, for example, that some of here that the last one, let's say lose your collateral fund, your secured payment, secure loan, that could be your car payment, right? You could be having your car repossessed, having your house foreclosed, and all of those. It takes a long time to reestablish. And also losing services, for example, even with your cell phone, if you don't pay them on time, and then if you have to reinstate, I have Cricket. So I don't pay a lot of monthly fees like I used to pay Verizon with the stupid interest. I mean, insurance amount and all of that. I have Cricket. So, but Cricket, if you don't pay your monthly payment on time, and we are grandfathered in, both my children and I, for the entire bill, it's actually $90 for unlimited data. We were grandfathered in from many years back when I gave up on Verizon. But with Cricket, if you actually don't pay that on time, and then they have to reinstate your service, I believe they charge at least $30 to $45. And so that's something that you would have to actually pay additional, right? And I know that even this utility, if you actually don't pay them on time, and you have to ask them to, let's say, returning back your electricity and all of that, you have to pay fee on that. So there's definitely benefit on not just to paying on time, but also to eliminate certain fees. So right here that it talked about, there are certain steps that you can actually, when you're dealing with collections, right? Some of them were already talked about that. You may getting a phone call, and I would say that, I know that some of the collectors, they're pretty aggressive, but you also know that as a consumer, by law, they cannot actually threaten you at certain ways, and they can't give you misleading informations. You can pay attention to how they're behaving on the phone as well, right? And knowing that where they're calling from, and also be aware at this point that I think it was last week, I got this call, not a call, actually, I don't know, all of you received this, but I got a text to say that, oh, I owe IRS something that they're going to, I was like, yeah, right. IRS would never text me. It's absolutely insane. That would not be true. Where I actually got a phony text that was a little scary. It looks like it looks like a text from Citizens. It's telling me that one of my Citizens savings account that somehow I missed certain things. I would have to click on the link to re-verify my savings account, the Citizens. I was like, yeah, right. I work for the bank. They would never send out anything like that. But the thing is that that as soon as you're receiving certain things, just be very careful, right? Especially that your bank's not gonna ask you to verify your account. If you calling a collection, let's just say that if you owe debt to Citizens, you have a car loan with Citizens, and you call in, they don't ask you for your full social. They generally ask you for the last four, right? When you call in, sometimes the automated system already can detect you from the phone number that you call in, and you verify yourself, but they're not going to ask you certain information that it's tied into so many different things that will actually release your personal information, right? Thank you, Jen. Oh, I didn't even realize we passed time. Yeah. So I think we'll finish from this slide. So I think, as we mentioned, that there's so much about debt collections, debt management. So just while you're paying attention to how important it is to pay off your debt, be very, very careful that as a Gen AI, it's now everywhere, that we need to also, as consumers, to pay attention to what are our rights as consumers, what can you utilize your knowledge and experience, but at the meantime, that how can you empower yourself to learn? How much do you owe? What's the principal? How can you pay that off? Can you talk to the collection agency to figure out certain things to really finding out solutions, right? So, and then obviously learn about credit report to see that how can you actually use the credit report to empower yourself with the information and help you to manage that. So what I will do is I will send out some trackers, I believe that I have for this particular one that I have created for my own. I teach other classes in the community as well. I will send those to Jen. And then, you know, she can send this out. And I will also send you about the Social Security information as well, okay? All right, well, thank you so much, everyone. I want to just see that if anyone else have a quick question before we wrap this up. All right, thank you so much, everyone. It's been a pleasure to be with all of you. And if you ever need anything else, feel free to have Jen or Carrie to reach back to me. Okay? Thank you.
Thank you so much, Erin.
You're
Really
welcome.
valuable information. We really appreciate that. Okay, as part of the Worth and Wealth program, you are also able to access free financial coaching with Oriana Felkowski. The information to register is right there in the QR code. That will also be in the follow-up email. Next week, which is the 20th of November, we will be talking about planning for retirement. Again, QR code is there, but when we send that email out, information will also be shared in the email. I hope you can join us. We have a free digital financial education tool through Enrich. Everybody in Massachusetts can take advantage of the platform. Again, QR code is there. We'll put it in the email, so you will have access to that. Please sign up, share it with friends. Thank you for joining us. Thank you, Erin. Thank you, Jennifer. We'll see you next week.